Welcome to the Minnesota SCORE Chapter's webinar on Understanding Financial Statements and Sustainability, presented by Arsene Hermiston. Judging by the number of people who are here already, this is a hot topic. Before we get started, just a little housekeeping. This presentation is being recorded and you will receive a link to it as well as the PowerPoint slides in the next week. Just give our admin a little bit of time. Sometimes people are so anxious that they are contacting us an hour after the event wondering where they are, but we will get them to you. If you have any questions during the presentation, please note them in the Q&A box and we'll answer them at the end of the presentation. So this is actually the fourth in a series of free presentations on the topic of finance. You're going to receive the links to the other recordings and a link to register for the next week's topic, which is financial forecasting in a post-pandemic economy. Oh, sounds a little heavy, but it'll be great, I'm sure. What is SCORE? SCORE is a nationwide nonprofit organization affiliated with the Small Business Administration. And the thing is that we provide free confidential mentoring and educational services like this. Our chapter, the Minnesota chapter, has nearly 90 volunteers serving Manatee and Sarasota counties in Florida for over 50 years. SCORE has assisted over 11 million clients since its inception 50 years ago. SCORE can help you in all stages of your business, whether you're thinking about opening a business or you have opened one, but you're trying to get it going, or you want to grow your business. Or lastly, if you're thinking about selling or closing, don't just lock the door and walk away. There might be value there. We have a team that's dedicated to help you understand what your exiting options are. We recommend that you go to our SCORE website, which is minnesota.score.org, and you can request a mentor, find a workshop or webinar, locate a podcast, or search our library for resources. Lastly, we want to thank all of our sponsors and community partners. Without them, we couldn't do the work that we do. Now I'm going to turn it over to our presenter, one of our outstanding mentors, Arsene Hermiston. Take it away.
Thank you, Diane. Hi, everyone. My name is Arsene Hermiston, and I will be going through the understanding of financial statements. I promise I'll try to keep it interesting. I know going through financial statements and numbers can be daunting, and that's sometimes a little, be honest, can be a little tiresome and dull, but we'll try and keep it a little light and make it interesting and move it along. And obviously, please, at the end, as Diane said, keep all your questions. I'm happy to answer anything that you would like. Background-wise, I come from a banking and finance background, very familiar with financial statements. As a banker, it's what you sort of live with day in and day out. It's important when you're working with your clients. The clients have to present statements to you so that you can make lending decisions. So it is a very critical part of running a business, just as important as being passionate about a business, your marketing, your social media, all aspects of the business. This is one of the key components, especially when you're starting, and more importantly, if you want to grow, is how you can get financing. So as we said, this is understanding financial statements and sustainability. And when we talk about sustainability, we're talking about your ability to maintain your business and grow your business and look at it as a long-term opportunity. And the key question is, you have to always be asking yourself, am I making money? That drives your growth, that drives your business, and that drives your sustainability, your ability to stay in business. So what we're going to try and cover here is, where does the money come from? What are the components? Some of it is very common sense. Where it went, where did you spend your money, and where it is now. Let's just make sure we understand where the cash is, where the income is, and this will lead you to understanding where the growth is and what is the health of your company. So in terms of what do financial statements show? So financial statements are like a report card on your business. They reflect your activities. They reflect what comes into the business, what you're spending on the business, and what you're going to be keeping on the business. This is an important element, as I said before, because it has many uses. Your report card are used by investors. Those could be people who will join you investing in your company, putting money into your company, helping your company get started. They would like to see numbers and how you're going to get from point A to point B, and if you are really getting from point A to point B. Your lenders and your bankers, initially, they're going to be your biggest partner in any kind of venture that you choose. They're going to want to see how you are performing, because that's how they make a decision on how much to lend you, if they should lend you money, and more importantly, are you going to be around in order to pay back what you borrow? And then if you're a larger company, this relates to a more publicly rated company, it's all the regulatory agencies that you hear on the news, you know, the IRS, the SEC. Well, the IRS applies to all of us, individually and as a business, but you know, the regulatory agencies do come into play when you are a large company or a publicly rated company. And most importantly, they're very important to you as a business owner. It's a significant tool for you to monitor all along the way, all along the months, quarters, and years, how you are performing, and are you actually accomplishing what you think you are accomplishing. I think the best way, when I was a baby banker, they taught us that these are the days where you actually wrote checks and you had a checkbook and you wrote down everything that you did. Financial statements are no different. It shows where the money's coming in and how you're spending and what's left, and are you doing all the right things. So that's sort of an analogy I always like to give, and it always stayed with me for years. So what are the key components of your financial statement? When someone says, okay, what is your financial health? What is your statement? What can you show me? There are 4 components to a financial statements. It's your income statement. This is effectively showing you, again, the revenues you're making. Revenues can come in the form that you can hear the word sales, and sometimes you can hear the word income. I prefer revenue and sales, and you'll see later on why I say that once we go through that. Then you have your expenses. It shows, when here it says including depreciation and amortization. These are some accounting components, and I can touch upon them later on, but effectively it's all your expenses. So what comes in, what's everything that I need to spend on, and then obviously your net income, what is left. And that is the number where you get actually, you can hear it as profit or loss, or net income or net loss. I mean, those are interchangeable. And then at the end of the day, it's also what you get taxed on, and then you have post-tax income. I mean, these are just more words, but just, get through the concept. You have your revenues come in, you have to spend on things that you need. That could be your electric bill, your heating bill. It's, again, no different than what you have personally you need to go through. You have your salary, you have your rent, you have all these different expenses. It's the same for a business. And then obviously then what's left at the end of the day. The balance sheet basically reflects what you own and what you owe. You have the assets. So what do I have on my balance sheet? Depending on your business, you always have, you can have receivables, or you can have inventory. You could have fixed assets. That could be a machinery. You can have property that you own. And then obviously then you have liabilities. What are liabilities? They're what have you done in order to support your assets? Did you borrow? Who did you borrow from? So it details all the items that you owe against those assets. Sometimes you may not have any liabilities, which typically you do. It could be your trade, people that you owe payables, your vendors. That is a liability item. And then obviously at the end of the balance sheet, your assets less your liability shows your equity. That is effectively what you have remaining in the business. Equity can come in many forms. You start your business with an initial equity, and what does that mean? You'll hear the word capital. Capital is effectively an initial investment. You want to start a business, you put some of your own money in cash into the business, and you may have friends and family who also provide you with capital, and that would be part of your starting equity. Now, the key thing about equity is that it is not like a liability. If somebody gives you money to start the business and there are no strings attached, we view that as free capital. It's no different than if you drew that under your personal checking account and put money in the business. Sometimes that could be in the form, if you are a public company, you issue shares, and then that also becomes part of your capital and everything else. Your net worth actually is a measure. It's also considered as part of your equity, or again, these are accounting measurements. So, but when you hear the word net worth, that's effectively taking all your assets, subtracting all your liabilities, and that just tells someone how much you are worth. It could be in that number, it could also be the value of your home if you're an individual, or the value of your assets is considered part of the worth. So that's how what that means. But the key business, if you're a small business, you're starting out, when the word equity or capital is used, what they most likely refer to is how much money has gone into the business that's free, meaning that you don't owe it back to someone. Then you have statements of changes in equity, and we'll show in the next slides. You'll actually see the numbers that are put to these sentences. Your equity effectively moves around, and the things that impact your equity are: you add more cash out of your own pocket, so that increases your equity. You reduce your liabilities, so you have more assets, and if you're subtracting liabilities to come up with your capital number, you're of course going to have more capital because you have less debt, you're less levered. And also a matter of how much money you make, meaning when we talk about how much money you make, we talk about profitability. After all your expenses, how much is left, and that change impacts your equity. Again, little math involved. And once you see the numbers, that will make complete sense to you. And then you have cash flow. Cash flow actually is a very important number. We all deal in net income. We pay taxes on net income, or income, and then that becomes net income after taxes. But cash flow is effectively cash. It's your checking account. It's your savings account. It's what you have. It's what if you walk into Starbucks, you give them cash. So the key component of cash flow is how you turn your operating assets. If you are a business that has receivables, you extend credit to people you sell to, the key component of that is how quickly do you get paid. So it all has to do with cash coming in. The best way to look at this is to say to yourself, what do I have left at the end of the day that I can deposit into a bank account? That is your cash. And cash can come from different points. If you borrow from a bank, what do you get? You get cash. But then remember, if you have cash, that against that you have a debt. So some of that cash that comes in will have to go to pay the bank. So cash flow is a very important number. It's what you pay your creditors with. It's what you pay your vendors with. It's what you take and run your business with. It's all depending on cash. And cash is a function of how you manage your assets and how you manage your liabilities. So when you prepare your financial statements, you will prepare them you can prepare them monthly, you can prepare them for quarterly or yearly. For some of you may be using QuickBooks, that already does a lot of these sort of items for you. That could be something you run on it's up to you. You can run them on a weekly basis, depending on how you would like to view your business and how closely you want to monitor it. And what you will do is, we'll go through this again through a chart, and maybe easier for you to follow it. What the key components are, again, revenues, cost of goods sold, gross margins, expenses incurred, the SG&A, and net income. I know I went through these a little fast. I think it'll be easier if we actually show you when the numbers appear. It just makes more sense. So let's go through what is typically an income statement. You have your sales. Effectively, that's what you're charging for items that you sell. Think of it as, I'm selling, let's just call it books or a ruler or whatever it is, whatever item it is you're selling, or a service you're providing. You could be a web page designer and you charge people by the hour or by the web page, and you have a certain amount of income or sales coming in. So that's that number. It's what you charge, what you bring in as your sales. Now you have two cost items. You have a cost of goods sold. So cost of goods sold, as it's broken out here, it's your materials, your labor, your overhead. That overhead typically is your electricity, your heat. If you have a building, it's items that you have to pay for, whether you sell one item or 5 items. It's like, a stadium always has to have its lights on, regardless of if you have sold 8 tickets or 2,000 tickets. So that's an overhead that a football stadium bears. And normally with goods sold, cost of goods sold, and you will notice it in businesses, it relates to businesses that are where you're producing a product, an item that you can actually see. So you'll see them having those types of business will most likely have a lot of good cost of goods sold. They will have materials, stuff that they have to order, whether it's parts and whether it's fabric, whether it's nails or hammers or whatever, inventory. And they will have a lot of labor. It's a labor, you hear the word labor intensive. That means it's a business where they need to hire a lot of people. UPS is a business where they need a lot of people, they need a lot of trucks. So, and then of course the overhead, it means that, regardless of whether you sell 1 item or 20,000 items, there are certain things that no matter what you have to pay for. That's your fixed costs. So businesses that are heavy in those sort of types of work will typically have a higher cost of goods sold. SG&A basically stands for selling, general, and administrative expenses. Depending on what business you are in, this may be the larger of your expenses. These are effectively more for service companies, where you can effectively have 4 people in a room producing some technology-related service. In these types of businesses, you will spend more relative to your growth. And the beauty of having higher SG&A than cost of goods sold is that SG&A is a flexible item. You can sort of expand it and reduce it based on your sales. Again, like if you don't need two programmers, you can always, say thank you and no longer use them. So you don't have to sort of overburden yourself. Your rent, you can always shrink your space, as opposed to owning a space where, then you have to get into the hassle of trying to sell part of it or sell all of it. So there are certain things in here that are more flexible than you have with cost of goods sold. Probably more information than you need, but I just thought, given that a lot of our industry and businesses these days are gravitating to a service type business, don't be surprised if you see more SG&A when you're producing your financial statements rather than cost of goods sold. And then once you go through through all these items, you come up with a number of pre-tax income. It's sort of very self-explanatory. This is all the income that you retain out of the business. And then obviously you have to pay Uncle Sam, you have to pay taxes, and then what you retain in your business is net income. In a lot of startup businesses that are new, it usually takes time to become profitable. I would say you usually don't be surprised if it takes you a year or 2 to become profitable. That's why you have to actually invest a lot upfront out of your own money. And unless you're very fortunate and there's a business model that produces profitability right away. But typically with a new business, it's not surprising if it takes about 12 to 18 months, even sometimes 24 months to become profitable. If you look at any of the large tech companies that you read about in the papers, if you really go in and look at their financial statements, you will see some of them aren't even making cash flow that we'll cover later. Some of them don't even generate any income, but they have value because of the service or the innovation that they are producing. Look at Amazon when they first started, any of the tech companies, they hardly had any. I mean, they may have had cash because people are buying the products, but when you have to sort of put it all back into R&D, there isn't much left at the end of the day, but they still have value because of what they produce.
Could I just ask you one question that came in? SG&A.
Mm-hmm.
SG&A, you have that as SG&A expenses. Could
Yes.
you just repeat what SG&A refers
Sure,
to?
absolutely. SG&A is selling, general, and administrative.
Thank you.
Yeah, so, yeah, please, if I'm talking too fast, or slow me down. Or,
No, that was just a question, and I thought it was a good one, so I.
yeah, excellent question. I've sort of touched upon these. So again, what are the assets? I told you there are things that you own and must be paid from either your own money, you borrow, you've generated enough profits that you have in the company that you can use towards it, or your prior year's retained earnings is basically, let's say you made money, you have net income, and you can use that. And again, this is it's not very fungible in concept, because typically you don't pay things with your earnings. You pay things with cash. You write a check, or whatever it is that you wire monies. Earnings is a accounting feature that just shows it's a measurement, but it also shows you that you're building capital. It means you're making money. So when they usually say current year's earnings, because it is a factor of cash flow, you start with that number. So you're starting with a positive number, but it literally is not something you can take out of your pocket or your checking account and pay. It's more of an accounting terminology. And I covered in terms of, what your equity is. It's assets equals liability plus equity. I like to think of it as assets minus liability equals equity. I don't want to confuse you, but you can look at the formula either way. But at the end of the day, equity is after, you have your assets, you have your liability, which you owe. Assets are what you own, liabilities are what you owe. And at the end of the day, when you subtract your assets from what you owe, it gives you your equity, your net worth. And if you sit down and, someone asks you what's your personal net worth, you would use the same formula. Here's what I own. And normally as an individual, the biggest assets we have is our home. So when you apply for a mortgage, they'll always ask you to fill out that form. Okay, here's all my assets. And you can put your personal assets in there. When you're applying for a mortgage, your home, your car, your other personal assets. And on this side, you always put down what you owe. And it's similar for a business. Here is a visual of what assets, liabilities look like. So a standard company, again, will have cash on the balance sheet. Hopefully, yes, sometimes you're cash zero if you haven't put in anything out of your own pocket in there. You have your accounts receivable. Accounts receivable is what people owe you that you've sold. Excuse me, I'm just gonna. So when you sell something to a company, whether it's an item or a service, you tell them, okay, if you want you have to pay me, you have to wire me cash. Or you say, okay, you can pay me in 30 days. So that generates an account receivable. And you have to then have systems to make sure you monitor it and get paid on time. Your inventory, these are items that you bought so that you can sell to people. Let's say you want to start an online business on selling sort of craft t-shirts or some kind of a product. In that case, what you will have is you will have inventory that you bought. Let's say you're representing someone who makes these wonderful organic t-shirts with nice designs. So that would be your inventory. You will buy a whole bunch of them and you will get your orders in, and then you will sell those. Now, when you sell them, you may charge by credit card, which you would get paid right away. Or you may say, okay, you can pay me in 30 days for something, you give your customers that you really like the ability to pay you over time, and then you will generate your receivable. And then as you collect as the inventory turns, it moves, becomes a sale, and you collect your receivables, then you'll be able to throw off cash, because now you've received the cash that you need. Now you go into the other part of the balance sheet, which effectively reflects what you would hear, your fixed assets. So when we talked about cash, receivables, and inventory, they are your current assets. And they call them current assets because they turn currently. They turn within 30 days, 40 days. It's a fast-moving part of your balance sheet. The equipment and the building is fixed. you use your equipment if you're making something, so that's not going to move around. And you have your building, it's fixed on the ground, and you use it for your businesses. Depreciation is, again, an accounting item. It is used as a measure of valuing your building. It's basically taking, saying, okay, if you own your building, you're going to own it for 10 years. Each year, the use is going to depreciate the value. Now, we're not talking about market value here. We're talking about what's known as book value. It's like your car. When everybody says, okay, you drive it out of the showroom and the price or the value goes down, except for now, you know, used car prices are skyrocketing. So it's an accounting concept. It's just the way they reflect the value, the market value of an asset. I'm sorry, the book value of an asset. And then you may have land. I mean, you may own the land the building is on, so that has value as well. So in this instances, your total fixed assets are 250, and your current assets are 96, and you may have some other assets, and that could be you may have some kind of a, let's say, instead of some kind of other asset that you sell or you use in your business that you have to buy. It could be a printing machine, your computers. Those could be your other assets that you own. It's effectively things that you own, assets. And then you show your total assets, what they are. Now, excuse me. Now, how did you get these assets? How did they come about? So you can use short-term notes. Short-term notes, you may hear the word line of credit, and what they are, effectively, that's what they are. These are notes that are due, have maturities typically less than 1 year. And, you know, they may be a series of them. They may be, you may have something that they call like a business revolving credit. It's like a credit card for a business, and you can borrow, repay, borrow, repay. As long as you owe money under that, it will appear on your liability. It's no different if you have debt outstanding on your credit card. It always shows, you know, what you have outstanding if you pull your credit report. Accounts payable, that's what you owe your vendors. Again, this would be the person you buy your inventory for, or the person who comes and repairs your computers, or this could be the person who does work for you and is the one that supplies you with all your supplies. So this is basically your vendors. Then you have some taxes payable. These could be your payroll taxes, for example. Let's say you pay them quarterly. That would be that item. It won't be your net income taxes that you pay based on your annual earnings. And accruals are line items that you accrue. You sort of don't have to pay them right away, but you sort of know that you're going to owe them. Let's say you have a subscription for a certain kind of magazine, and you only pay it once a year at the beginning of the year. You know you're going to keep it, so that's something you accrue for because you know you're going to owe it at some point, and you just want to open up it's a liability to you. Or it could be for people who you pay on a contract basis. You know, maybe you pay them every so often as opposed to a regular. You're accruing that liability over time. And CPLTD is basically current portions of long-term debt. So let's say you take out a 15-year debt. For example, consider your mortgage. Obviously, they show it here. Your mortgage is, let's say, $200,000, but you don't owe the $200,000 right away. It has a payment plan. Let's say it's X dollars amount every year, and it's monthly, and it obviously has to be multiplied by 12. It'll give you your annual rate, your annual portion. So it's just that portion that's owed in that year. So it's you're basically what you owe to the bank on your mortgage, and the same for long-term debt when you borrow that. When you borrow long-term, typically you will borrow long-term for an equipment. It could just be you have long-term needs on, for some kind of a fixed asset that you need in your business. Could be for your computers. It could be for your other types of machinery. Let's say you print small items and you need a pressing machine. So you will take a long-term debt for that portion, and it's the same concept. what you're reflecting in the long-term liabilities is what you call the absolute amount of the loan, less what you've paid in that year. So if it's a $100,000 long-term loan and you paid it down by X amount, you'll show it whatever that 100,000 is less the payment of that year. So it's a net number. Now, one thing I just want to reiterate here, that typically, if you are going to borrow, let's say your business is in a position where it can borrow and you're talking to your banker or your financier, they will try and match short-term debt with short-term assets. And I'm going to give you an example. Let's say you are a business that has really good accounts receivable. You have very good customers. They turn every 30 months. Inventory turns. However, you have a business that's a little seasonal. You have months where it's high sales and months that are low. It just follows. It could be a business where you are selling clothes and you are focusing on, let's say, swimsuits and coats. So your swimsuits sales are gonna go really up in the summer and your coats are gonna go up in the winter. Now there may be a lull. So what you have to do is build up inventory for the swimsuits and then let's say build up inventory for your coats. And you don't want to have them in advance because the fashions may change and you want to see what's sort of in. During those lull sales time, you still have to run your business and you have to buy the inventory. So usually you would use these lines of credit and are short term because you don't want to lock yourself into a long term, and banks will work with you. What they'll give you is a short term loan, so as a bridge to some of the ebbs and flows of your business. And since your assets that reflect this portion of your business turn quickly, it's called short term. Like you're not going to take a mortgage out to support your inventory because that doesn't make sense at all. So again, a little bit more than you need to know, but that's why you have short-term and long-term liabilities in this example. It's trying to say, okay, you support your long-term assets with long-term debt, your short-term assets with short-term debt. And that's something, as you grow as a business to be, it helps you communicate with your bankers and everything else. Excuse me. So then you have the equity portion. We talked about that. It's your initial investment in the business. It's your retained earnings, what you have retained over time. And net income is normally the net income, the income you made from the previous year. So retained earnings is a continuum. Let's say you've been in business 3 years, it's your 3 years of earnings. And then your current net income for that year. Add that to what you put in the business. It's your net worth for this specific balance sheet period, and shows you what your net worth is. Apologies again. So what is the all the items that we have taught? We showed the effects of what net profit or loss. These are sort of more change. Let's step back. So what can impact your equity, your net worth, or the equity part of your balance sheet? We saw that when you added, when net income was added to that worth number. Well, if you had a loss that year, that net income number is going to be a minus. So that's going to reduce your equity in the business because you lost money. Dividend payments, if you're a business that pays dividends, I mean, you don't have to be a public company to pay dividends. You may have a partnership, and each partnership period, you take money out in the form of dividends. That's going to reduce your net worth. Returns on capital investment to owners. Let's say the cash you put in, you sort of want to pay yourself back. So that's going to take money out of your initial investment. Let's say you want to make an additional investment in the company and you use that again, and you're going to reduce your net worth. And of course, sometimes there are accounting errors. It's just effectively, what do? You just keep everything in the company and not touch it or take it out of the company. And we hear a lot of that on the news about large companies paying dividends, and everybody gets upset because you're reducing the worth of the company when they pay dividends. They're effectively taking money out of the company. taking money out of the company to reinvest in the company actually is not a bad thing. That means you're sort of putting it back to help grow the company. You're choosing to do that instead of borrowing. You know, and it happens, and it may be for you the right thing to do, or it may not be. So it's always worth talking to a banker or financier about, you know, why give up what you have when you can borrow and then pay it over time. So I suppose mostly a judgment call and everything, a decision point that you need to make when you're talking to financing and to see what's best for you. Are there any questions before I go further? Okay. You're muted.
There are a couple of questions. Please repeat the explanation of CPTLD at the end, she was asking, but maybe if you have a brief review that you could do of that. And what is total capital on the balance sheet? Okay, of course. Do you want, should I wait? I can, since I have it on the screen. CPLTD is current portion of long-term debt. It's the amount you owe, let's say, every month on your mortgage. That's the current portion that you owe on your mortgage. In this case, the company has $115,000 mortgage. It's a commercial mortgage. It works just like a personal mortgage. But each year, the amount this business owes to the business every year is $3,000. It's probably a monthly payment, and it adds up to $3,000 for the year. So that's what this is reflecting. It's the amount you owe on your mortgage every year, as opposed to the whole amount of the mortgage. That's the long-term portion. And total capital is effectively your total equity. And people use the word capital and equity and net worth interchangeable. Net worth, when you mention the word net worth, it usually relates to an individual. When you use the word capital and equity, it's usually for a business. I personally should probably change this and make it total equity, because the column says equity, and it's what your equity is, what you own in the business. It's the value of the business at a given point in time, reflecting that your initial investment of $100,000, you have been able to retain earnings, net income in the business over the past 3 years, let's say, of $39,000, and then past year's income, this year's income, let's say the statements are, let's say these are 2021 statements. I know they're not in the example. So your total capital will include what you previously put in, and obviously you haven't touched it. You haven't taken and paid dividends, taken money out for yourself. So your initial investment, the cash you took out of your personal checking account and you put it in the business when you started it, that's your $100,000. Then over the past 2 years, you've made $39,000, and that reflects that you've been a positive profit company for 2 years, and you've made net income. You've made net income of $39,000, and then the year you're preparing the statements, which you said is 2021, you made another $147,175. So the addition of all that is your total equity, what you've built up in the company. It's like when you have a house and you have a certain amount of mortgage and you keep paying down the mortgage, you're building equity in the house. And that's why you can borrow, let's say, an equity line. A little different, but it's sort of conceptually, it's the same. One short question. Richard wants to know, so this balance sheet is based on 1 month's time, but that's not necessarily so, right?
No, so balance sheet, that's a great question. An income statement is your activity over a 12-month period. Always. It's like a, you know, if you're doing a monthly, it's for the month. If you're doing it quarterly, it's for the quarter. The income statement is just sort of shows your business over that time. A balance sheet is a moment in time. That's why if I have a balance sheet and today is February 16, 2022, and I issue a balance sheet, it's just as of now, what do I have? I may do this balance sheet for tomorrow and it may look totally different. Because let's say all the account receivable collections have come in. So that 40,000 may be 80,000 because I've collected on the 40. So an income statement is sort of the activity, and a balance sheet is a point in time. But it always reflects these items. It shows your assets and as of today, your liabilities as of today, and your equity as of today. So a balance sheet is a snapshot.
Good.
And your income statement is like your checkbook. You know, how much I've made, what I've spent on, and how much I was able to keep, and then, you know, put it in, you know, and save it. So that's sort of the analogy you should think about. I hope that answers the question. If not, I'm happy to.
Absolutely.
Okay. So we sort of talked about this. I'm going to skip this page. I just made it a little bit more simple. I mean, some of the words here was just showing the movements I was talking about. So this is the changes. So as I said, what changes, you started with your initial investment of 100. This is just showing what makes the equity or portion of their balance sheet. And we talked about that. We said you had 100,000, you accumulated income for 3 years at 39,000. That's your total worth of the company. And then this year you made 47. So that's the total. That's what could make your equity portion go up or down. I mean, if you had a loss for 47,000, then you would have to subtract it from the 139. And obviously your total balance for the equity would be less. So now what we're going to talk about is what is cash flow. So cash flow is a very important component. When you work with numbers, I'm just going to say from a banker's point of view, you'll see income statements. But at the end of the day, what they train us to do is zero in on cash. Because cash is what makes it work. Cash is what you have. Cash is what you pay things with. And it's very important to understand when you hear the word cash flow and how it comes and what are the components and what gives you cash. If you are a business, you're operating activities. And what does that mean? It means, do I get paid for the services that I have done? Paid meaning are they remitting the wires in? Are they sending in the checks, assuming you use checks, and more importantly, are the checks cashing? Then not bouncing, and and obviously if you have credit card, it's cash because it's between the credit card and the person who's being charged. So the question is, if my assets are receivables, am I collecting them on time to contract them and generate cash? Because once you collect, it becomes cash. Am I turning my inventory on time? When I turn my inventory, that means I am selling, generating receivables, generating cash. That's why you should never have stale inventory. And you see sometimes stores having these massive sales because they just rather get rid of the inventory rather than pay to keep it, because most likely they've borrowed against that inventory and they'd rather just blow it out, pay off their loan, and not have to carry it, not having to keep paying interest or principal on it. Financing activity, that brings in cash. But it could be borrowed cash. You can get, once you borrow, you get cash, but then you have to also pay it. So that's cash that from financing. Somebody gives you money, a good friend, or your family, and someone believes in you and just writes a check and says, "I believe in your business," and that's cash. That's a capital infusion. That's an equity infusion, and that's cash too. Or you can have. Use it for, because this is more talking about the investing, and you can use to invest in PP&E acquisitions and or return drive actions. I just blast through that because that's sort of not what I want to cover here, but it just shows you what you can put your cash into, and we can talk about that. So again, you generate cash through your operating your business, you collect on it, you're selling, you're putting, getting cash, and you're putting it aside. Financing activities are what you borrow, what's provided to you as cash, and that's cash. And then the other portion, investing, is where do you put your cash, which is a very important factor, is how do you use your cash. So here's a example of a cash flow statement. It starts with your net income, net earnings, what you've had. So that's your starting point. And this is, again, a little bit of accounting here, but it just shows you what the flows are. And I'm going to go into a little bit detail, and you know, I'm happy to repeat it because, again, it's going to mix a little bit of accounting with a little bit of reality. So this is so that you understand the line items here and what's relevant to you. So what items do they allow you to add back to that net income? Because net income is, again, it's an accounting term. It depends if you're accrual, not accrual, cash accounting, all things that you may come across or you may not come across. But if you file business taxes, it sort of follows this logic too, because you're allowed to do certain things. So when you calculate, or when someone calculates your cash flow from operations, you start with your net income, what you've made on a net income basis. They let you add depreciation. So now when we went through the balance sheet, depreciation gets, when we went through the income statement, depreciation gets subtracted from income statement because that's what you have to do for accounting purposes. Depreciation is not a cash item. It's an accounting concept. It's not like you put money aside and say, okay, this is my depreciation. You can't see it. It's not cash. So they allow you to add that back to your net income number because you haven't actually paid cash. Your decrease in accounts receivable, we spoke about that. That means collecting. When they say decrease, when you contract your accounts receivables, that means it's been converted to cash. So that's a good thing. Some companies have huge receivables and they collect them really late. So for a period, you'll see that to be a use of cash, well below the line. You increase your accounts payable. This is an interesting concept. This can be good and this can be bad. So basically, when it says you increase your account payable, you're effectively delaying payments to your vendors. The good way of this, and the good thing about this, is your vendors may like you so much because you're such a good business and such a good client to them that they give you terms. They give you 30 days to pay them. So that means you are their receivable effectively. So if you have good relationships with your vendors and they give you credit for 30 days, that's a good thing. They trust you. They think you're a good businessman. You pay your bills on time. So you get 30 days of something that you don't have to pay. So that is a cash in your balance sheet for that period of time. The bad part of that is if you let your, is sometimes when I look at a company and I see the accounts payable growing and that's support giving me an illusion there's a lot of cash, it could be a bad thing. It could be you're just not paying, and that's not a good thing because you basically owe people money and you're being a bad customer and you're being a bad credit. So that will send signals up to me that maybe you're not a good person for me to lend money to. So anyhow, but in this case, let's just think about this. Your increase in accounts payable, meaning your ability to delay payments for 30 days or 45 days or whatever the terms your vendors give you, is a period where cash is still within the business. Taxes payable, that's the concept of payroll taxes and everything else. You don't pay them like right away. There's a period where you have to pay them. So for that 3 months that you don't pay them, it's cash that hasn't left the company. And then, of course, in this example, there are increases in short-term notes, meaning what? It means that you have borrowed money. You have increased your borrowings. From a cash flow perspective, it's a great thing. There's more cash coming into your business, but at the end of the day, it is a borrowed cash. So you have to sort of keep that in mind. Things that you subtract from this cash, as I discussed before, if your inventory keeps going up, it means that it hasn't moved. I mean, there's cash sort of staying in the inventory, so that you subtract that from cash. And if you have increase in accounts receivable, is what I have spoken about. Your accounts receivable are growing. That means you're not contracting enough of your account receivable to generate cash. So it's sort of the opposite of what we did, above. These changes gives me an idea that you throw up $49,000 cash for a specific period. And then so what do you do with that $49,000? Or what have you done with that for that money? So here's what you've decided to do, because these are what your needs are. You had to buy $10,000 worth of equipment. You decided to use cash for that. You decided that you needed a building for $111,000. That's the use of cash. So now what you're showing me is that you have $121,000 in cash needs. How are you going to do that? How are you going to support that 121? You obviously only made 49. It's not going to support all of it, maybe parts of the 10, but you don't also want to leave yourself with no cash at the end of the day to put into your business checking account. So what you do is you go to the bank, you borrow the $10,000 for the equipment. Like I was saying, you can go buy it. And then what you do is you take out a mortgage and which is a long-term debt for $130,000 for the building. So that's you borrow $140,000 to support $121,000 of cash needs, and that leaves you at the end of the year 2015 $68,000 that you can put in the bank. So that's how cash flow works, and it's a very important component to a financier or a banker, because we all know that businesses need cash. They generate cash and they need cash. They need cash to get started. They need cash to grow. They need cash to run their day-to-day business. So what a banker looks like is, what are the components? Fine. You said you took your cash and you bought an equipment. Very good, because that's something you need for your business and the growth of the business. You bought a building, you're expanding, you need the space, a very smart move. So I'm happy to lend you that. The building, I'll appraise it and I'll lend a certain amount against it. And your equipment, that's great. That's a good news. You're buying an equipment because you're growing and you have great projects that you need that equipment for. And so I'm happy to give you $10,000 for the equipment, and I'm happy to give you $130,000 for the equipment. And I know that you generate $49,000 in cash, so I will take that number and I will see whether that's enough to pay back my loan. The building, it's going to be that mortgage. And what did we see on the other page? That your mortgage was $3,000 a year. You're making $49,000. You can support that payment. And for the other one as well, the equipment loan, the current portion. So when I look at that cash flow number, I see whether you can support the current portion of your long-term debt. The short term, normally, it works a little differently. It's like a credit card. You pay it, you borrow, you pay it off, and you borrow. So that's how I look at your cash. I said, does the $49,000 support the $3,000 a year of current portion of long-term debt? And of course, there's some other liabilities, and you have to sort of sustain your business. And I see, okay, after all that, you still generate $68,000. But what you've done is, your cash flow shows prudent cash management. You're not going ahead and buying a Maserati or just going ahead and spending it, for a limo for the bank, or buying a private jet or anything. That's what when we bankers go scour through the financials, we just want to make sure you're using your cash the way you're supposed to be using it. Sure.
Just a couple of questions. I think they're on your mathematics. Could you please go over again how $68,000 was calculated on the cash flow statement?
Mm-hmm.
And then, so she added 19 to 49 to get 68. How did she get the 49 again?
Okay, the 49 is, you start with your $47,175, your net earnings or net income. You add back depreciation. You add back the 15, which is your increase in accounts payable. You add back your taxes payable for 5. You also add back your 10,000. So those are your key sources of cash right now. Then what you subtract, your inventory increase, and you subtract the increase in accounts receivable. And I do apologize, that increase in accounts, decrease in accounts payable on top. Then you add back you subtract increase in inventory, and you subtract increase in accounts receivable. That should give you 49,000. So that's how the 49,000, the difference of your additions to cash and subtractions from cash.
And the 68,000 at the bottom.
And the 68,000 then is the continuum. You take the 49,000, you subtract 10,000, you subtract the 111, you subtract the 121, you add 10, and you add 130, and that should give you the 140.
68. Okay, good. Thank you.
Of course. I have to take out my calculator to make sure my brain doesn't work as fast anymore. Okay, so now we have ratios. Ratios basically, so why do we look at ratios? So ratios are just a division. It takes your certain line items and divides by sales. In concept, it's measuring, are things good or are things bad? And you hear the word margin a lot. It's a percentage. It's you're saying, okay, how do all these expenses and my profitability relate to sales? Am I a high margin business or am I a low margin business? For those of us who live in the world of cosmetics and shampoos and everything else, if you ever had the ability, which nobody ever does, understanding how much people have margins over, let's say, shampoo, you'd be surprised how much it is and how much they make it for, how much you're making it for, how much you're providing your service for, and how much you are making on that sales. How much margin do you have? How much do you retain from whatever you are making? And that's basically a mathematical formula. It takes whatever these line items are, which we talked about, and divides it by sales. So when you hear the word margin, it's a low margin business, it's a high margin business. It's effectively, these are the ratios that are being generated and commented on. The other thing you want to look with margins, and we'll go through that, but I just want you to get the concept first, is it gives you a trend. So I can look at absolute numbers any day. And I can say, okay, it's good or bad. I can just sort of, know it. But when I look at a company, I always look at the margins because it gives me a good trend. It's part of it is arithmetic. I want to make sure that if my costs of goods sold are going up, but my sales are not going up, that percentage over time is going to show me that my cost of goods sold is eating into my revenues. And that's bad, because are you spending on things that are unnecessarily because you just think your business is going to grow, or your sales are going to grow, and it's just, why are you building why are you hiring more people if you don't have the contracts? So I always want to make sure that that ratio sort of makes sense. Like if cost of goods sold, the absolute number, the dollar number, all of a sudden jumps, I want to make sure that your sales jump too, and proportionately, if they're the same percentage, that you're not doing something that you really shouldn't doesn't make sense. Like you're over hiring, you're over buying equipment, you're over buying inventory just because you think it's going to be the next best thing until you blow it, and now all your other numbers are going to go down. So we'll go through that. But conceptually, that's what it's measuring. Are you moving in sync with your sales? Or is there something funky happening there?
These margins often are industry specific, aren't they? That in an industry, yes, you would expect certain margins.
Yeah, it's more, it's because, we're most likely everyone's in the small business arena or medium-sized arena. You are correct. There are industry standards and certain margins that can say, okay, every widget manufacturer, in this size should have margin. These are the acceptable industry margins. But then, it gets a little different depending on region. Like, is a widget maker in California expected to have the same margins as a widget maker in Florida? Maybe the labor forces are different in terms of what the prices are. Well, it's getting narrower in differentiation. So the best way to look at it, and if I'm just rambling here, is now people who work from home. I mean, look at a lot of the office spaces that people may have owned the building, and people were showing up, and now they give away half their office spaces because people can work from home. So the margins sort of change, but the equivalent office may still require all their people to come in and have to get that expense. So the answer is globally, in general, yes. People in the same type of businesses, there's an industry standard of what's considered a good margin. But you have to use it as a benchmark rather than, try and strive to meet those margins. Even bankers, when we look at those margins, we look at it with a grain of salt because they are retroactive. You look at it's a rear view mirror calculation, but it's a good sort of benchmark to look at. Like if you're way off, you're going to say, what am I doing differently than what my sort of cohorts and peers are doing?
Brad wonders if there's a website or a place that you could find these.
Sure, and I will go through that. If you could just be patient, we actually show that to you. There are many. Some you may have to pay for, some you don't. But there's actually just to tell you, there's an organization, and as when you're in banking, and you're a big contributor to that, is especially if you're on the private side, meaning you deal with companies that are not public. Once a company is public, you could just, you can put Coca-Colas and compare it to Pepsi's, and you just pull their public information. But for privately owned businesses, you don't share your numbers publicly. I mean, they're private information. So a lot of bankers on a no-name basis say, hey, I'm lending to a lot of beverage distributors. You don't give the names, but you give all their information, so the ratios are calculated for these organizations, and it's all done by revenue size and everything else. So there is, when we get to that page, I will show you what it is that we contribute to. So here are the ratios. You have cost of goods sold over sales, and that gives you a gross margin. So what does a COGS? What goes into this COGS? It's your labor, material, and overhead. And so this is just showing you the numbers. It's showing you your COGS total are $322,500 over your $500,000 in sales. So your profit, so your gross profit margin, you will see that word is 64.5%. That's a pretty good gross profit margin, quite frankly, depending on what your business is. So again, as I said, you track them monthly to get an early jump on pending problems. All of a sudden, if you see that falling down, that means something's happened. Again, you build up your labor force too quickly. And sometimes maybe you need to do that. Maybe it's the best thing you need to do. You sort of meet with your, if you have a partner or something, say, hey, listen, we are sure about all these contracts that are coming through. We have 5 that are coming through. We already inked it. It's definitely, we've signed it, it's in the bag, and we need to, there's a labor shortage, let's get the jump on it and hire 4 people, because we're going to need to be able to deliver on these great contracts. So you may see, for 3 months, that 64.5 may have dropped down to 58.2, because you build up on your labor force. And, as a banker, I'd look at that and I'll pick up the phone or, and tell them, hey, what happened here? And they'll explain to me, hey, this is good news for us. We have 5 new contracts. We wanted to be prudent, go into the marketplace a little earlier and be able to secure, 3 more people so that we know we're ready to go when the contracts are supposed to start. Same with material, you need to build that up. So it's a very important number to look at and understand why it changes and why it shifts. These days, everything with inflation, prices are being increased. I would not be surprised if I took a bunch of companies today, regardless of size, that their margins are going to be lower than historical because of all the, the increase in prices. So you sort of have to use a little bit of common sense and logic as a lender to understand why their movements are happening. Now, if it all of a sudden drops to 30%, it means they're not absorbing their environment and the changes very well because they hadn't built enough equity in the business. See, when we talk about equity, we talk about capital, same thing, is because it is where your cushion in the business is generated. It's almost like it's what keeps you afloat. And that's why we all like to see people having good capital, and we like to see why people have good cash. And one of the biggest component was retained earnings and net income. And if you start having losses because your expenses are too high, you're going to start eroding that part of your balance sheet. So it sort of all relates into how you run your business. And this is assuming you're not pumping money into the company to float up your retained earnings. And I'm going to digress. The reason people use capital and equity interchangeable, capital comes from more like the stock market and that concept. Because if you issue stock and it comes into the business, it comes in as they call capital. But if you're a regular business, you have a private business, you're a small business owner or middle market business owner, it's normally retained earnings because you're not in the market raising debt through the capital markets, through the public market. So I just thought I'd throw that in as to why people use it interchangeably. I think it's wrong. I think you should call retained earnings, and capital. So, but it's just something that has gone into the nomenclature. So here we talked about gross profit margins, basically the variance in the cost of goods sold and why it's important and why it needs to be monitored. And why sometimes there's a good explanation as to why it moves. And that's what we were talking about. Your gross profit margin is is basically taking the same number here, and it's the COGS minus your sales will give you your absolute gross profit margin, and then you just divide that, and that would be your actual gross profit that you have. It's your gross profit margin. So effectively, let's go back here because I think I may have skipped this step. You take your cost of goods sold, which is an absolute number, and you divide it by sales, and that gives you what your percentage of costs are to your sales. Then you go one step further, and you take the difference. You took your sales, you subtracted your COGS, you came up with 177,500. That's your gross profit. That's the difference between your sales and your cost of goods sold. You get your gross profit, you take that profit and you divide it into your sales and you get your true gross profit margin. So effectively it's 35.5 and you have a 65.5%. Your cost as a percentage of your sales was about 65.5%. And then your margin is 35. And that's a decent margin. Most service businesses in general have margins between 8% and it's a little bit of a range at 15%. Most businesses that have assets, meaning they're not just a pure service company, tend to have higher margins because they control that sort of, they don't have to outsource as much to think about it. So they retain more margins in the business. So just a little tidbit for you. So we figured out how to calculate your cost as a percentage of sales. And now we're looking at the margin of 35.5%. So then this is the SG&A. So selling, general, administrative, this is more, again, as I said, in general, when you have a service-based industry, a company, and you generate more SG&A than you do your fixed costs, because you have employees who can work from anywhere. You have it's more like a lot of the technology companies have higher SG&A. Some of them don't even have cost of goods sold, because it's just their product and their designers or programmers or other employees. So here again, you take your SG&A, the absolute number, and you take it over your 500, which is your sales, and 23%. So you're in that example of the business we had, it's always more of a manufacturing type business. So you had higher cost of goods sold, you also had higher margins. Then you come down and now you have 23% in your flexible selling and general expenses, same concept. You look at why it goes up, why it goes down, what are things that can sort of impact it. And maybe you decided to pay higher bonuses that year, and it could be anything. So that's another benchmark that you can track and follow. If you're looking at a service company where that's a more important number, you go through the same analysis you do as if you were manufacturing and you paid a lot of attention to the gross profit margin. And it's all about movement and trends and how it's going from one year to another, and again, understanding why. Something may go down, but it may be for a good reason. So it's really important to understand your margins. And here's again, the net income to sales. It just shows you how much at the end of the day, same concept. Do you retain in your company your net income, your margins of your net income? The key thing is you don't want to be so low that there's no cushion being built. And you know, we can go back to what we just started with, which is how do you compare to your industry standards, tracking your variance, comparing your net income to prior months, and basically, does your profitability level meet your needs, goals, and expectations? What does this all mean? At the end of the day, when you started your business, you had a passion, you had a thought, you had an idea. You did all the fun things. You hired the marketing people. They just sort of, you know, told you this is what's going to take to put you out there. More likely social media, Google Ads, and everything else. Things have become a lot more, tools have become a lot more efficient these days if you're a small business, because there's so much there available that you should be able to do online. And just to plug for SCORE, we have tons of experts that are focused on these. And if you have a mentor, they can shepherd you through all of this and connect you with someone who specializes in, you know, Google Ads, or someone who can help you even look at your financial statements. So if you don't have a mentor, definitely, if you haven't accessed our other seminars, webinars, definitely do, because it will tie everything together for you for this day and age. So let's go to the next slide. And here's some of the industry information that will help you. Again, use it as a guide to see whether you're sort of, you know, still in the reservation and not sort of going off into some different paths. All businesses in the US, in the United States, have what they call standardized industrial classification and North American industry classification system. Different entities providing you with similar concept numbers. These numbers are really, really used by a lot of the governments, like the trade associations and everything else, to see sort of, you know, what business are. And a lot of these codes are, they can come in two numbers, which is like the general, like it'll say manufacturing. Then you go to the 3 code, it'll say leather producer, I don't know, this producer, that producer. Then you click on that and it even goes down, down, down. It's almost like a 4-digit code that can go down to, or even more. It gets a little, you know, like they'll say, it can go down to like the minutia of the business. So just find out where you relate. And if you do technology, the spectrum for technology is huge. Which part of the tech spectrum do you operate in? You just have to be able to compare yourself to your peers. So this is sort of areas you can go into to see what the standards are. And there's other sort of information in the library that you can use. And I think for the emergent intellect, you may need a sign, and I don't know if that's a paid function and a paid website, or if it's for free, but you can find a lot in the library or even online on all these industry standards.
It's my understanding that all you need is a library card to access.
Yeah, absolutely, because I'm sure they all subscribe. I mean, these are just, you know, and again, always remember, these are rear view. Okay, so this is when they gather information. It's I don't know how current it is these days in trying to do these types of analysis, but it's important. Again, it gives you a benchmark and everything else. And then let's see what we have here. So I talked about, before I go here, any questions, clarifications?
You know, here's a simple one. Does the cash flow statement cover a whole year?
Good question. So a cash flow can be for the month, for the quarter, for the year. It's, again, you know, as long as you have an income statement, your balance sheet for that period, you can come up with a cash flow. But people most likely, it's try and do cash flows on a monthly basis if you're starting out and you're a new business. If you're an established business, you know, it's always good. Most likely, if you're dealing with the bank, they would like to see it on a quarterly. But I always recommend, you know, keep an eye on your business on a monthly basis. I know it's tedious, but it's worth it. Try to stay ahead of it until you season. You know, if once you season, then you sort of know the ebbs and flow of your business, and you can go on more of a monthly or a quarterly basis. But also, just to take a few minutes, when you start your business or you run your business, this is just showing you the performance of your business at a given point in time and over time. It's very important because you have to create a budget for yourself. You can call it projections, you can call it budget, you can call it business plan. Well, business plan also includes your overall business operating plan, your marketing plan, and everything else. But it's very important to create a budget. And again, to sort of plug for SCORE and the mentors, they can help you do that. There's actually tools on our website to help you develop a budget. And just sit there and tell yourself, okay, how do I want to run my business? Always do it on a bottom-up basis, meaning what? Always look at it and say, okay, here's everything I need to do before I open my doors. And how is everything, and think it through and say, what is it all going to cost me? Right? Because there's cost involved. And then ask yourself, okay, how am I going to meet that cost? I'm going to put my own money into it. I'm going to, just borrow, or, I have friends and family who are going to invest in it. And then think to yourself, how much am I going to charge for this business or my services? And then when you get to this point, ask yourself, how much margin do I want to make? Do I want to be a 20% margin business? And what does that look like on an absolute basis? Okay, if I run my business at a 20% margin, what does my cash flow look at the end of the day? And is that enough to sustain my business? So it's a very interesting exercise, because once you do that and you have a view for the first year or even the second year, and be realistic, it's very important for you, because that is sort of what you can measure yourself against and say, okay, year one, I generated 68,000 in cash flow, and I was actually thinking maybe I would generate 72. So what did I why am I sort of below? And then it's very important to take that and maybe break it out to a monthly basis, because then you can look at your results on a monthly basis and adjust more quickly. But once you're seasoned, then you can say, okay, maybe I'll look at my performance every quarter, because now I sort of know the operating rhythm and what my company does. But it's always important to start with a budget, start with the concept, put numbers against it, and then, always measure yourself against yourself and what you thought you were going to do. And that's a very critical component and how you should use this in preparing your budget. So we went through all of that. I hope that answers the question. And then yes. We did that. And so here's the SCORE website, and you go SCORE Minnesota. And what you can do on this website, you can find a mentor, you can take a workshop, and you can browse the library. Now, I have to reiterate, everything we do is free. You don't have to pay a cent. We are all volunteers. I'm a volunteer, Diane's a volunteer. We do this because we just want to give back based on what we have been able to do professionally, and we think it's important. So you go on our website, depending on what you want to do. But if you would like to find if things work out well, and I wish they will, and that's the reason why they shouldn't be, you can always give back. You can be actually the one, sitting at a webinar sharing your experience, or you can become a mentor. We're always looking for people to become mentors to help other folks who are starting a business, and what they should expect, and what are some of the ups and downs and challenges, and just, to help people get a reality check. If you want a mentor, if you haven't, had a mentor, you feel at any stage of your business, you need to be brainstorm with someone. You need to sort of, check, make sure you're on the right path, help you with the business plan, help you with any part of your business. You can ask for a mentor. The good thing about SCORE is we're very networked within our own counties, but also nationally. So there's one thing I'm not very up on. I don't know. I know marketing. I know what it is, but I don't know how to use the social media or any Google ads for marketing, or web management, or sort of what SEOs that do. These are people who optimize the web page. It's just not my strong suit, my wheelhouse. So what I do is I look on our website that we have access to as volunteers and find out who does. And I say, hey, can you please co-mentor with me? This is a very specific, in addition to leading, let's say, putting together a business plan, they also need help with how to sort of position their company using social media. And you'll have that person who will come and help you and guide you as well. So it's a tremendous free resource. I mean, we highly recommend that you try and, go on the page, just browse through it. There's a huge library of other courses that could be extremely useful to you. And it's just good to hear them, see what people do, and there are other testimonies and everything else. You have take a workshop. There are workshops available. I know with COVID it's been a little challenging. It's not in person, but it's online, but it's great. It just gives you, it's just another tool in your toolbox, and it'll help you, be better at what you're doing, but also learn a couple of new things. And it's very important. And again, it's free. We have podcasts and business articles that can help you. You can read them, you can listen to them, and they can be very, very helpful. You can listen to them, while you're having lunch or something if you're too busy. The other is the library. We have so the library is important. Not only does it have topics like what I'm presenting, but also the continuum of, let's say, other things relating to financial. And all the past one, it has an archive. You just go in there and you say, okay, SBA loans, or how do you do that? And they'll give you a whole menu of articles, webinars, everything. And you bring bankers in who provide you with information on that. So you should definitely use that. But the other thing that it also has, we have a lot of templates that we put together to help you. So I was talking about a budget and then putting together like projections. Well, there's a template that you can use to get started. About putting together a more of a business plan. We have that too. It's a template, and it tells you the steps you sort of need to think about or focus on. That maybe not every step relates to you, but at least it just triggers you to think it through. So I would say it's a definite plus. Look into it, and I just want to spend some time thanking you for your patience. Please, if there's any questions, I sort of talk fast through something, please let me know if you need more explanation on. But again, thanks a lot, and it's been a pleasure.
There are a couple of questions. Maybe we could handle them quickly. It's we've run over a little bit. So Brad has one that's a simple one. Is their score? Is score one-on-one there to help me, or do I need to hire someone? And I think that, as we've just heard, you can go onto our website, you can download these templates, you can try filling them in yourself, but a SCORE mentor will in fact work with you one-on-one for free, and we will customize these templates to your needs. So absolutely reach out for that. Elena would like to know, could you please go over again how a banker compares short-term debt to short-term assets?
Sure. So let's go back to that screen. Okay, so let's just go to the balance sheet. So typically the rule of thumb as a banker is you want to provide financing to what we refer to as short-term assets or current assets with short-term loans. And the rationale is, since you generate cash flow from your current assets fast, meaning what? Meaning if I'm going to lend you, when I say lend you against your receivables and inventory, typically a bank will take a lien on those receivables and inventory. It's not unsecured. Until you grow a little bit, then they'll be willing to give you unsecured financing. And the banker says, I'm very comfortable giving you short-term notes against your accounts receivable and inventory because I know you turn them into cash in 30 days or 45 days. And I know you'll be able to pay down those notes as you collect those cash. So that's sort of the mindset. And then they look at short-term notes against short-term assets. So why won't they give you a short-term loan against a building? Because most likely you bought your building and let's say also equipment to build stuff over time. And that over time concept is, again, it's more from a manufacturing standpoint. It takes a long time to build something. Let's say it's a fabrication factory. These are all probably more older type industries. Because it takes you over time to generate something out of a building or an equipment, they rather give you a long-term, because they're considered long-term assets and they have a longer cash generating cycle. It's more ongoing. Rather than a short-term asset, it turns quicker. It turns between, I mean, you squeeze cash out of these assets every 30 or 45 days. Well, something like a building or an equipment is just think of it visually, it's heavy, it's on the ground. It's a long-term, sort of value to it, and it depreciates, and then you have to say, okay, I have to then bring my loan down because it's the asset now worth less because it's being used. So that was sort of the original thought process when we looked at these. It's like the same concept. You won't borrow short-term. You're not going to charge on your credit card to buy a house. Your credit, you're not going to, you're going to have to pay your credit card over like a few months while the mortgage is, you stay in the house for like a long period of time. You wouldn't be able to do it over time. So that's the best way I can explain it to you. But you finance short-term assets with short-term loans, what's considered a long-term asset with long-term loans. You're not going to switch your equipment every 2 days every 30 days, and you're not going to change your building every 30 days. So that was the original concept, but in general, that's how it works. I hope that explains it a little.
Typically, our taxes 35% of LLC.
Mm-hmm.
Oh, that was an easy one. Lily has a question. Let's see if Lily is still here, and if so, Lily, I'm going to allow you to ask your question because I'm not sure I understand it. So
the question I had was that with the owner's equity, okay, you talked about how if you invest $100,000 right up front, owner's equity, but over a period of time, like that owner's equity increases sometime when the owner, like you said, can buy additional equipment or something that they end up paying cash for because they didn't get that loan. So the owner's investment line, that continues to increase over a period of time on that balance sheet. Because I see it quite often, sometimes on the balance, that's the only place we can stick the numbers is in that owner's investment account.
So let me just clarify couple of things. In this example, the 100,000, when they talk about owner's investment, it means the initial cash you put in to start your business. It's what you, and you are correct. That owner's investment can come in the form of, nowadays, they allow it to be in they consider it and consider it owner's investment. You can start a business by putting in cash. You can start a business by contributing a building you have. You start a business by contributing equipment you have, or by contributing a land you have. Bankers, as well as I think accountants, because it's something you own, you've already paid for it, and you're putting it into the business, they consider that as owner's investment. The value of what you're contributing, or cash will be cash. 100,000 cash is worth 100,000 cash. But you may be contributing a property that now is worth X into your business. So bankers will discount that because property values go up and down. They'll take an average and they'll say, okay, so you put in, let's say, it's not going to add up in this example, but let's say hypothetically, you put in $100,000 in cash to a new business. I'm starting at the time zero. You had a building that was appraised at, or its worth, or your initial purchase was, let's say, 50,000. So you contribute that to the business. You just give it to it and no strings attached. You're not going to take it back at some time. You just, here it is. We're going to clean it, sweep it, and put in our equipment in there. And you go and buy the equipment personally and you put it in, or you had it in anticipation and put it in. Anything that you spend your own personal money into it goes initially as your equity, it's owner's investment, because it's yours. It's pure contribution to the business that you make. And you can make these contributions over time. So it doesn't stop at zero. So that will then owner's investment goes up, and it gives you more worth to your company, because you could have gone borrowed and done those things, but you did it. You basically risked your own self, to use a word, you put more skin into the game, because that's what people want to see. Your retained earnings is effectively what your business produced over time. So that could have started, year one at 10,000, year two at, 20,000, and year three at 9,000. That's just a cumulative sort of number. And then your net income is for that year, for that period that you were for that period of time that you were reflecting your balance sheet. So all those together is considered what's equity in your business.
And the reason I'm saying that is because when I'm working with small business owners, say, for example, in the first year or two, they're really not making that much revenue.
Correct.
And they're spending some of their own personal money to buy some additional supplies, to pay for the rent, because they didn't gross enough revenue that month to pay for the rent. That additional cash they're putting in their business causes that owner's investment line to continue to go up every month, sometimes, and sometimes, throughout the whole year. That number is constantly going up beyond that initial $100,000 investment.
Correct.
Okay, so that's what I just wanted to make sure. When you said owner's investment, you were saying the initial investment into the company. My question was that, as a banker, when you're evaluating this balance sheet, in that owner's investment can also be additional cash that was put in every month at first year or two, when the individual was paying expenses that the revenue did not cover.
Correct. That means they keep putting money into the company. At some point, that has to stop if they aren't making any income or any cash. So that's a question. But you're happy. Your banker will look at that and say, all right, so he's risking his own stuff. And, I'll look at the merits of that. But then I go and look at, is this a sustainable business? How long can he keep doing that before he turns cash flow positive, so that I can lend to him? So, then it becomes, first it's the facts. Then you have to think about the facts. Not every fact is good, not every fact is bad. I mean, at some point, you're going to say, hey, maybe this is not a good idea. You're just draining yourself and putting good money after bad. So then it becomes more of a judgment call of how you look at the numbers. But you are correct. Anytime you contribute to the business out of your own, cash or assets or whatever, it's considered as part of the owner's investment in the business.
Okay, perfect.
Thank you, Lily. That was great. Okay. All right, I think we have no more questions, and I think I've got all the comments handled, the chat, and I can't thank you enough, Arsene, for sharing your expertise with our participants. It's interesting to see how many stayed on to the end.
And didn't fall asleep.
I don't know that. No, I'm sure they didn't fall asleep. It's an interesting topic, certainly. And just to reiterate, go to our website, download some templates, try filling them in. If you need any help, apply for a mentor. It's free and it's easy, and that's what we do. We like working with people. As you can see, our mentors are passionate about what they do and want to share their knowledge. Well, thank you all for coming. And if you have any further questions, you can reply to the email that you'll be getting about the link to the webinar, as well as you will be receiving these PowerPoint slides. So that should help a lot. All right. Well, thank you all. And
thank you.
Have a great day.